Baruch here with genConnect and Joseph Quinlan. So Joseph, let me start out by asking you if I'm invested comfortably. I think that, all my investments are going well. A lot of people were saying things like this back in 2008, right before the crash.
That's right.
What should I be looking out for? What are the pitfalls that I should be careful not to become entrapped in?
I would be, make sure your portfolio is diversified. And we always hear that, but that really means broadening it out to not just stocks and bonds, but also, say, farmland, timber, private equity, hedge funds. So an established investor really wants to have that diversification, because if there's another shock or a crisis, which most likely there will be at some point in the time, you can weather the downdraft and have some cash on hand as well. So in particular, own large U.S. companies, we believe, that pay dividends. The dividend payers, because if there's some turmoil, but if there's good cash flow, you still get paid.
Now, when we say diversified, are we talking really diversified evenly across all these sectors, all these investments, or should we still be focused in one specific area within the diversification?
Really, we still prefer equities to bonds right now, and I think that's going to be our story for the next, say, 12 to 18 months. But we're seeing within our clientele a real emphasis on hard assets, i.e. owning timber, owning farmlands, owning MLPs related to energy. So a lot of people want to own hard assets because they're worried about inflation, they're worried about all the monetary policies globally. So that's part and parcel of that investment bucket.
Now, let's say I have a discrete amount of money. I want to invest it right now. I'm a new investor. Where am I putting that?
I would put it in the large cap established names that have been around for 100 years. So whether it's consumer staples, whether it's information technology, energy, industrials, play it safe here. We've had a nice 5-year run. We're doing a lot of IPOs right now, but we're not chasing those. No one knows the true value of some of these companies. So I would go more conservative, established names as opposed to the sexy IPOs.
Amazing. Thank you, Joseph.
Thank you.
And for more with Joseph Quinlan, be sure to check out genConnect.